Hey everyone, thanks for joining this video. In today's video, I'm going to talk about 3 different ways that you can start getting a return on your excess cash position, whether that's money that you're sitting on in your brokerage account, a ton of money you're holding in your checking account. I'm going to give you some alternatives that you can consider, talk about why this is something you may want to consider, especially in the times we're in. So if you like this kind of content, be sure to give this video a big thumbs up. It really does help me with the YouTube algorithm as a small channel. But we're just going to dive right into it as I just show you how much money I've been losing in my portfolio over the last week. So you can see here, down over $4,000 in my Canadian account, over $3,000 in my US account. So I've lost about $7,000 this week, but that's besides the point. This video is about cash positions. And with markets as volatile as they are, interest rates moving around like they are, and some equities, as I go through some of the stocks in my portfolio here that are down big, that are down 20-30% on a year over year basis, you may be thinking that you want to make sure you have some money on the side for either dry powder for if the market keeps going down, you want to buy in at lower prices, or who knows, maybe it is just as a security net or a safety net, safety deposit fund for you in case you lose your job or an emergency comes up that you have to pay for. But it's lots of reasons to have a good cash position. With that being said, interest rates right now are around 5-6%. And those are rates that are not really expected to go down anytime soon. So for me personally, I don't really like holding a ton of liquid cash in a checking account or just sitting in the balance of my investment account, because it's just a huge opportunity cost lost from the value of money right now that's just getting lower and lower on a daily basis for a dollar. So how I personally have been addressing this is through putting money in this ETF here, CASH. We're going to talk about this ETF, but also a couple other options so I can kind of evaluate live whether it's worth me doing something else as well. Looking at ETF cash here, you can kind of see, I've talked about it a couple times before, but pretty much just accrues interest throughout the month, pays you a dividend or distribution with the accrued high interest at the end of the month, and then does the same thing again and again and again. So I actually own about $17,000 in this account. It gives me about a 5.4% dividend yield. So I'm getting almost $1,000 a year in dividends or distributions just from holding that $17,000 in cash within this ETF with, I never say no risk, but this is about as low risk as you can get in terms of where this money is being invested. It's just being invested at big banks and high interest funds. You can kind of see here, I think the yield's a bit suppressed, probably looking at a trailing 12 months when interest rates were a bit lower. But it's paying at about a 5.4% yield, which we'll look at later in this video. So the cons of this are that you have to pay taxes on a monthly basis, or you're accruing taxes on a monthly basis on the interest that you're getting here, right? So that is one of the cons. Another con is with ETFs in general, you tend to pay a management fee. So the management fee on CASH is about 10 basis points, I think, so pretty low versus lots of other ETFs. But that's still one thing that you would want to consider. So this is how I've been managing my cash position. Overall, I have about $17,000, which is about 7-8% of my overall Wealthsimple portfolio here that was sitting at just over $200,000. So that's like a decent cash position. Lots of people have bigger cash positions, 10%, 15%, 20%, depending on how conservative you are, what stage in your investment journey you are, if you're close to retirement or needing to take money out to buy a home or something like that. But I'm pretty comfortable with the level of cash position I have in my account here. With that being said, there are other options other than this ETF here that I wanted to share with you guys in this video. And the first one is just having a GIC. So this is more, I quote unquote, old school, but what lots of people have done historically before lots of these ETFs got created is just have a direct GIC You don't really pay a management fee here. You just take the fee, the GIC rate that the bank gives you. And I'm just going to highlight some of the top ones that I found here across the Canadian market. You see here, EQ Bank usually has really competitive rates for GICs. So they have a 5-year at 5.1%, a 1-year at 5.75%. And just to state the obvious, I'm not getting paid to push any particular product or bank here. I'm just kind of showing you some of the options that I found. So the pro here is you don't pay a management fee. If you want the 1 year, you're getting about 25 basis points higher on a 1 year than you're getting in lots of these ETFs because you don't have to pay that management fee. But your money is going to be locked up for that 1 year time. So if the market crashed 20% next month, I wanted to invest that $15,000 to $20,000 in stocks. If I was in this GIC, I would not have the opportunity to do that. So that's your opportunity cost of going into a GIC. Obviously, that gets more pronounced when you're looking at longer term GICs. 5 years here, you're locking in a 5.1% rate, which, hey, may be good. 3 years from now, rates may be lower and you may be getting a great return on your investment relative to what you can get for cash in other places. But it is posing the risk that interest rates go higher, or you may need that money for an emergency, or you may want to invest that money in stocks if one of your highest conviction stocks crash or whatnot. Who knows? Everyone's situation is different. But you are losing flexibility when you go into GICs. Some other GIC options here that I just was Googling on this website here, NerdWallet, in terms of the highest current GIC rates available in Canada. And you should, always read the fine print, especially with these top ones that are from banks that maybe you may be a bit less familiar with. Sometimes they have criteria, like you have to open an account with them or a checking account in order to unlock a 6% GIC or something like that. So just make sure you're aware of the nuances. But it looks like the top one here is at about 6% from this company, Wealth One Bank. Never heard of them. 2-year GIC, the best one, has a bunch, 5.7%, 3-year 5.4, 4-year BMO has a 5.35, and then 5-year here 5.28. So all of these are super competitive. When you talk about GICs, everyone's kind of working off of the same basis. So everything's the same, plus or minus 10, 20, 30 basis points, depending on what you want to go with. But, I would just say for these, you just have to be comfortable with your lockup period. No, you're not going to need that money over that period. Comfortable with the fact that you're locking in at this predetermined return over that period. But in terms of safety, these are some of the safest investments in terms of almost guaranteeing or being very confident you're going to get your capital and some more back that you can make. And over the last 5 years before interest rates started ramping up, GICs were not very popular because they were paying like 1%, 0.9%, 0.8%. Now you can actually lock in 5-year, 10-year GICs at historically reasonable rates, which is kind of a re-emerging investment vehicle for lots of people that have just started investing in the last 5-10 years that aren't really familiar with this trade-off opportunity that you can be investing in instead of equities or bonds. So just wanted to kind of share one of the other options. My personal reason why I don't invest in GICs is I don't like the lockup. I like having flexibility. I like being able to sell a couple $1,000s of my cash position, buy a stock, and then maybe the next month I'll sell a stock, put that money into my cash ETF position as I wait for other opportunities. And in the meantime, I'm making that 5.4% on my cash ETF position. Another ETF that someone actually shared with me in the comments on a few videos ago, which I was really grateful for, I did some more research on it, is this ETF here called the Horizons Cash Maximizer ETF, ticker HSAV, high interest savings potentially. And you can see the advantage on this ETF is instead of paying out a dividend each month, it just accrues on the absolute value of the fund. So you're getting capital appreciation instead of the monthly dividend, which has pros and cons depending on what you're looking for. For me, I'm getting that $1,000 a year in distributions, but I'm also paying tax on that. So lots of that $1,000 actually ends up going back to the government. I'm not exactly sure what tax rate that falls into. It's probably a distribution, not a dividend, so the taxes are probably a bit higher. But that's probably not the most advantageous from a total return standpoint. On the other side of the coin, I really do like getting my dividends every month, reinvesting them in other opportunities and other things. So it really depends what you're looking for and what you're going after. But this is definitely a great alternative for people who are very um, people who are keeping track and being very mindful of their taxes and ensuring that they maybe don't need the income right now, so they're not looking for income providing assets. They'd rather just get the capital appreciation. This is a great vehicle for someone who has a lot of cash, doesn't want to trigger a tax transaction, but wants to park it somewhere where they don't have to pay tax unless they sell the asset, but they're also not forced to sell the asset, but it's there to sell, and you still get your return if you do have to sell it for whatever reason. So a bit of a different use case for this one versus cash, but the total returns are almost identical pre-tax. So it really just depends what tax situation you're in, what lifestyle situation you're in terms of if you want dividends or you want capital appreciation, if you want to defer the taxes longer, if you want to be paying a tax, capital gains tax versus distribution taxes. But just going into this one a bit more, HSAV and cash have very, very similar objectives. They're really just looking to enhance the savings potential of your cash essentially versus holding it in a checking account or in a balance. They kind of call out the tax efficiency I was just going at. They don't make taxable distributions, which enhances after-tax performance versus other savings vehicles. Kind of a slight on CASH there, and then they just continually reinvest the net interest, which is kind of what we were alluding to on the last slide. You can get a bit of a sense here. Let's just say interest rates were 0.75. Obviously, they're significantly higher, but that would mean your pre-tax portfolio gain on $100,000 would be $750. Same in a traditional high interest savings vehicle versus HSAV or HSAV, sorry. And then if you were to assume taxes on interest income to be that tax rate there, you would have about half of it chewed away. So your absolute return is almost double on HSAV versus cash or another investment option. So that was really enticing to me. One of the cons of HSAV here is their management fees are actually closer to 0.2%, whereas cashes that we'll go over in a second are actually about half of that. So on an absolute return pre-tax, your return on HSAV is about 0.1% less. But obviously, if you're not holding this in a registered account, the tax benefits, if you're going to hold long term of HSAV, far outweigh that 0.1% in extra management fees. So that's something to consider when evaluating what ETF to go into if you were to consider an ETF. You see here over the last 1 year, total return about 4.67%. And you may be thinking like, this isn't a great total return. Over time, market goes up 7-8% a year. But this is not, in my opinion, not the right move to do with 100% of your portfolio. This is almost a zero risk return. So all of investing is all about risk reward. If you're investing in a stock that may go up 100%, it's probably more risky that it could also go down 50% or 60%. In this asset here, the chances that you even lose 1% are very, very low. So it's essentially no risk, or as little to no risk as you can possibly get in the financial markets, with a 4 to 5% return, which is below long-term averages. But the risk is also below what you'd expect out of pretty much any other financial security as well. Going into where they hold their money on HSAV, I found this interesting. They actually hold about 100% at the National Bank, which is different than cash as well. So we'll go through that in a second. But I'd say all of the banks are pretty safe. No, I don't think any bank's necessarily going to be going under in Canada anytime soon. So diversifying across banks is nice, I guess. But at the end of the day, I don't think national banks going out of business and the high interest savings deposits going to be impacted in any way. I think that's a bit of a doomsday Armageddon scenario. Okay, going over to cash. So we talked about this one a bit in my portfolio, so won't go over the stock chart again. But just going into their business here, you could see very similar use case here versus HSAV. Reduces risk in your portfolio, used for liquidity, potential new acquisitions in a portfolio. So they're kind of saying like, hey, we're going to be spitting out a dividend every month. You can choose how to use that dividend. You can leverage your cash position to get payments on a monthly basis through distributions to then take those payments those distributions and invest in other areas of your portfolio, which is kind of what I've been doing historically here. They also call out, instead of tax efficiency, which was called out on HSAVE, they call out monthly income as a benefit. So once again, really depends where you hold this, what your objectives are, and what you prefer as an investor in terms of whether you may want to prefer CASH or HSAVE for your cash position. In terms of management fees, like I was saying before, it's closer to 0.1%. So it's about half the management fee as HSAVE, and your gross yield here is about 5.4%. So nice little dividend yield there. As I look into performance of the fund, you can see here 4.74. So when I go over into HSAVE here, it's 4.67. So you're literally getting like about 7 or 8 basis points higher, probably mostly due to the difference in the management fee. The rest of their business and how they're going about getting the return is pretty much identical. The only other delta is what I noticed on cash here is they actually hold cash or funds across more banks. So you see Scotiabank 20%, CIBC 36%, National Bank. I guess National Bank's the best rate or the best place to go, 43%. So a bit of diversification here, but like I almost feel like it's not really required or value add diversification when you're talking about just holding cash in bank accounts. All of these banks should be extremely secure. If they're not going to go out of business overnight, if there was to be any risk in the bank's liquidity, I think it would be a bit of a roadmap to it. You wouldn't just wake up tomorrow and it would happen. You would kind of see it coming a bit more than having any risk day by day holding cash in these accounts. So, I guess a nice to have, but not really a consideration for me in terms of whether to invest in cash or HSAVE. So my takeaway for me, GICs, I don't think are for me. I just don't like the inflexibility of having them locked in, willing to give up the extra 0.1, 0.2% returns. But one of the things that did catch my eye was the HSAVE ETF. I really do like the fact that it's way more tax efficient for me, who personally is owning cash in an unregistered account. So I'm probably going to be paying a lot of that $1,000 I got in dividends, maybe $400 back in taxes at the end of the year, which would make having money in HSAVE actually a better proposition for me in terms of long-term savings, especially since I'm planning on holding a pretty sizable cash position into the future as well. So it's not necessarily just a 1 month thing or a 2 month thing. So thank you to the commenter who shared this ETF with me. It's definitely one that I will be keeping an eye on. And as I allocate more cash to cash positions, I may actually be moving it into the Horizons Cash Maximizer ETF. We'll share more on that on my weekly portfolio updates, but wanted to share these 3 options to get returns on your cash right now. You can very easily get very low risk returns of 5 to 6% through any of these mechanisms, whether it's HSAVE, cash, GICs, and you can even choose how you want that dished up to you, whether it's through monthly dividends, capital appreciations, locked into long-term agreements. So if you're holding a ton of money in your checking account, would highly recommend, getting some return on your capital by doing one of these options, or maybe there's other options as well. Lots of big banks offer high interest accounts with 1% interest rates and stuff like that, where you're just losing tons of money, in my opinion, versus taking one of these options. So, wanted to share this information for those who may not know or may not know about the breadth of options. If you like this kind of content, be sure to give me a big thumbs up. We talk a lot about specific stocks and portfolios, not typically cash positions, so maybe a bit more boring of a video for some people, but still wanted to get this out there in case it helped a few people or educated a few people about the opportunities in the cash markets. Be sure to subscribe to the channel if you haven't already, and I'll see you guys in the next one. Thanks.